So guys, we are going to discuss today study unit number 17. So unit number 17 is about internal controls. Okay. The main topic is corporate governance and internal controls. Unit 18 also internal controls. There we will talk about controls and security measures. So in unit number 17 and 18, so these two units are called internal control section. Okay, and this is your 15% of your exam. Although these two chapters are theoretical, but these chapters are heavily tested in your exam. So unit number 17 is having two topics. 17.1, which is about corporate governance and regulations relating to the internal controls. This we have already covered. So then we have a topic number 2, 17.2. (17.2) is about risk and internal control, which is the topic for today class. So here we go. We are going to start. Please listen me carefully. So first of all, we are going to talk about what is the definition of risk. So guys, how we can define risk? So we can say risk could be any unforeseen obstacles, or risk could be any event which might affect the company negatively. Okay, or which have a negative effect on the company. So let me give you examples. What I said risk could be any unwanted event we don't want. It could be any unwanted event. If this event will arise, it will have negative effect on the company. So let me give you a couple of examples for risk. Like in our business, for example, you are working in accounts department, so you may face the risk of exchange rates. Right, risk of exchange rate is also there, like when you perform cross the border transactions. So obviously you sell the product to the foreign customers, so you might have a receipts in the foreign currency. So maybe you are selling goods today, but you will receive currency in future, maybe if this transaction is on credit. So exchange rate risk is there. So another risk, I'm giving you different examples. You might have a risk of non-compliance also, because nowadays every government, they might issue new laws and regulations. Maybe unintentionally you might not follow that laws and regulation, and what could be the consequence? Maybe they can impose some fines on you. So this is also a risk is there. So you might have a operational risk also, risk of operation failure. So you might have a risk of theft, risk of embezzlement of cash, right? So there are many risks are there in your normal life which you face. So this is what I'm just telling you. What is the definition of risk? Risk is what is any unwanted event. If this event will arise, so it will affect the company in negative way. That is the risk. So risk could be the risk of hacking also. Nowadays we are storing our all information into computer system. So hackers, they can hack our computer system. So this is also a risk, right? So this is the definition of risk. Now we are moving forward. I'm going to explain the risk management process. Obviously, there is a process, there is a way which we can follow to manage the risk, right? Most of the time in large organization, you may have risk management department. So they are ultimately responsible for the risk management. Okay, so risk management, what is the risk management process? Like we are going to talk about how to manage risk, or which stages are there in the risk management process. So stage number 1 is what I'll explain one by one. So the first stage is identification of context. I'll explain what it is. Second stage is risk identification. Third stage is risk assessment and prioritization. Fourth, this is also called risk analysis. Okay. Fourth stage is called risk response. And fifth stage is called risk monitoring. So first you need to remember these overall 5 headings, and then we will go through each heading separately. First is what? The first stage is identification of context. Second stage is risk identification. Third is risk assessment and prioritization. Fourth is risk response. And fifth is risk monitoring. So what is the identification of the context? Step number one, the stage number one. So what is the identification of context? Here, identification of context means simply the area, okay, or the significant context within which you are trying to identify the risk, within which you are trying to manage the risk. So for example, it could be any area. Let's say maybe you are looking the risk in the laws and regulation side. Maybe you're looking the risk in the capital projects, long-term projects. Maybe it could be a construction projects. Maybe your area of focus, which is called context. Your area of focus could be specific capital project. It could be any business process. Okay, maybe production process, maybe purchase process. There could be a risk also. Maybe salary payments process, there could be a risk. So the context could be a technology also, because obviously when we use technology, we also have a certain risk, like risk of a virus attack is there, risk of hackers attack is there. Then you might have a context market risk, like what risks are prevailing in the market, which might include interest rate risk, foreign exchange rate risk, or any other risk. So you might have a context organization as a whole. Maybe you want to look the risk in the whole organization. This is called identification of the context. So identification of context means the area in which you are trying to identify the risk, the area within which you are trying to manage the risk. So this is the first stage in the risk management process. You have to decide the area. The area could be the whole organization. It could be a market. It could be a capital project. Now, guys, the second stage, which is called risk identification. Obviously, once the area is decided, now it is time to identify the risk. So you can identify the risk at entity level. Entity level means throughout the entity. You can identify the risk at divisional level also. Divisional level means to say, for example, like a Pepsi company, they have a division like maybe country-wise division. So country-wise risk can also be identified. Okay, it can be identified at business unit level, like at factory level, or it can be identified at departmental level also. Understood? So here, for example, I'm just giving you, if you are identifying the risk at entity level, like with the risk which will affect the whole organization, it could be a technological risk. Obviously, when new technology will come, obviously the old technology will become obsolete, right? If you're using still old technology, it will not give you any benefit. And another risk which can affect the entity level, like it could be a change in customer wants and expectation. Obviously, if you are not producing the products as per customer expectations, so no one will buy your products. Okay, so risk can be identified at departmental level also. For example, in warehouse, there might be a risk of theft also, theft of item. In accounts department, there might be a risk of fake payments. There might be a risk of fabrication of documentation. So there might be a risk of exchange rate risk. In compliance department, there could be a risk of non-compliance. You have to check. In IT department, there could be a risk of hacking. So it could be identified at departmental level also. Understood? So mostly this topic, the risk management process, they may ask the MCQs, like what stages are there, or which stages are the part of risk management process, or which stages are not the part of risk management process. But in essay question, they will ask you to define what is the risk management process. Then you have to define these 5 stages. Okay, so when guys we identify the risk, there are different ways we can use. So sometimes we can use the past data also. Like for example, maybe which is also called risk inventory, right? For example, in the past, you have identified certain risk and you have created a document for that, which is called risk profile. Okay, so you can look into that document. Maybe still some risks might be present today, or maybe you may also consider the future event also. Maybe, for example, if government is issuing new laws and regulations, let's assume, right? So there is a risk now. This risk will arise in the future. Why? Because you may not comply with their laws and regulation. This is called what? Risk identification. Then guys, third stage we have, that is called what? Risk assessment and prioritization. What is risk assessment and prioritization, guys? Whenever risks are identified, for example, you have identified 3 or 4 different risks, which can include risk of hacking, risk of exchange rate. I'm just quoting simple examples, risk of theft, a risk of misuse of assets. So for example, there are risk of fraud, there could be a different risk. So you have once risks are identified, after that, guys, you need to assess the risk. And whenever you assess the risk, so you will prepare table like that. Okay, assessment could be qualitative or it could be quantitative. I'll give you example of how risk can be assessed. So guys, for each identified risk, you have to check 2 things. Number one, what is the likelihood of that risk? Likelihood means the chances of occurrence. Second thing, you have to check what is the impact of that risk if this risk will arise. Please remember, whenever you assess the risk, for each identified risk, you will check 2 things. The likelihood you will check and the impact you will check. Understood? Likelihood and impact for each identified risk. For example, now there are 2 ways to assess the risk. One is called qualitative way. Second is called quantitative way. In qualitative way, qualitative first, we do not use any digits. Okay, but if digits have been used in the risk assessment, that is called quantitative. So first I'm going to code the examples for qualitative risk assessment. For example, you have 4 risks in total. Let's assume we have a risk A, risk B, risk C, and risk D. So guys, under qualitative assessment, we do not use any digits. We will use words like that. Likelihood could be like, for example, remote, possible, or likely. Remote means like chances are very less. Okay. Possible means like chances are there. Likely means there are high chances that this risk will arise. Okay. And for the impact, which kind of word we can use? Because we do not use any digit here under qualitative assessment. We use left words or phrases like that. Impact would be critical. Impact could be a major. Impact could be a minor. Critical means a big impact. Major, it is more than minor but less than critical. Minor, it is less than major also. Understood? For example, this is also called risk modeling. Risk modeling. You are doing risk modeling. For example, we categorize that risk A is having remote chances, but impact is critical. It means we will place it here because this table will be created, right? In risk modeling. For example, risk B is having possible chances and impact is critical. We will place it here. Let's assume risk C is having possible chances, but risk C I'm talking about, but impact is minor. We will place it here under possible in front of minor. For example, risk D is having high chances, high likely that this risk will arise, but impact is major. Now, guys, once this risk modeling is done, this is qualitative assessment. After that, you have to prioritize risk. Prioritize means rank the risk. Ranking, you have to do the ranking for the risk. What does mean by ranking? Ranking means to say which risk you have to manage first, which risk you have to manage at second. And there is no pet criteria for that. It is totally subjective area. Maybe in your assessment, you will manage risk D first because chances are high and impact is major. Maybe in my assessment, I'll manage risk B first. The reason chances are possible, impact is critical. So it is totally subjective area, but you have to do the ranking. You have to do the prioritization, which risk has to manage first. Okay. Now, if you look at here, we have a quantitative assessment. For quantitative assessment, again, for example, you can create the similar table, for example, but you can use here, let's assume, I'm just quoting one way for quantitative, because in quantitative, you can use the digits also. For example, for likelihood, I can use chances are 5%, or chances are, for example, 50%, or chances are 80%. For impact, I can use the word, maybe it could give you loss of 100,000. It could give you loss of 50,000, or it could give you loss of 5,000. It could be any amount. So when you use the digits, even only digits are expressed in percentage, but you can see digits are involved. So this will become quantitative assessment. Okay, so here we go. For example, here we have an event. Event means a risk. Here we have a consequence. Consequence, you can see kind of, impact. And here we have a likelihood. Likelihood means like chances of occurrence, probability. For example, here we are taking example. A company is assessing the risk of its system. It's like IT relevant, being penetrated by hackers. Like there are certain hackers which they are trying to penetrate into our system, which they're trying to hack our system. So there could be a minor penetration. Okay, what is consequences? It will be annoying for us. Maybe it can slow down our system. Okay, what are chances? Let's assume 90%. Now you can see digits are involved. It will become quantitative assessment. For example, there is another risk, unauthorized viewing of internal database. Like some hackers, they may hack our system and they can get access to our data. So this is the risk. What is the consequences? It could be a public embarrassment, loss of customer confidence, like maybe people will lose the confidence into us. How much chance is there? 8%. Like if you are doing this kind of assessment, this is called quantitative assessment. Okay, so what I told you, in risk assessment, you will check for each risk. You will check the likelihood, probability, chances of occurrence, and you will check the impact of risk. Understood? So, and based on that, you will prioritize the risk. Prioritize means a ranking. So that is why this stage is called risk assessment and prioritization. Once ranking is done, step 3 is completed, then we have to move to the step number 4. That is called risk response. Risk response and strategies. Like which strategies we can use to manage that risk. So guys, risk response means risk response considers how each risk should be managed. Okay, and there are mainly 5 strategies are there. One could be a risk avoidance. I'll explain. Second could be a risk retention. Third could be a risk reduction. Fourth, risk reduction is also called risk mitigation. Fourth is called risk sharing. Okay. And fifth is called risk exploitation. So let me explain what is the difference between these 5 strategies. Actually, we use these 4 strategies normally within the companies. So fifth one is mostly used by the gamblers. Okay. So let's have a look. But in total, you should remember 5 definitions. So what is risk avoidance, guys? Let me give you example here. For example, let me quote example first. For example, you are having some money, some saving with you, and I'm asking you to invest in the stocks, in the stock of ABC company. And I told you there could be a gain on the investment, there could be a loss of investment, but you have a risk averse attitude. You want to avoid the risk. How you will avoid? Simply, you will cease that activity. You will not invest. So this is how risk can be avoided. Or if you have already invested in the stock and now you are facing risk, that there is a risk of loss, you can sell your existing investment to avoid the risk. This is called risk avoidance. Risk avoidance means that simply you are going to avoid the risk by seizing that action or by selling the existing investment. This is called risk avoidance. So how it is defined? It is defined risk avoidance ends the activity from which risk arises. In MCQs, they will ask you what is the definition of risk avoidance. So you have to tell it's the end of the activity from which the risk arises. Understood? And I gave you examples also. Second strategy could be risk retention. Please, risk retention is also called risk. It is also called self-insurance. Let me give you example. Same example I'm quoting again. For example, you have some saving. I ask you to invest in the stock, right? I told you there is a chances of gain also, chances of loss also. Obviously, the chances of loss is risk for you. So what is risk retention? Risk retention is what? Risk retention means that you are going to accept that risk, like you are going to invest, but you are going to accept that risk based on self-insurance. Self-insurance means that you are not going to get any third-party insurance. So you are saying that, oh, let's invest and we'll see what will happen and I'll bear the consequences. So that is called risk retention. So risk retention, how you can define, guys? In risk retention, what you will do, simply you will accept the risk. Simply you will accept the risk, but you do not have any strategy to reduce it. You are going to bear the consequences by yourself. So that is why it's called self-insurance. This is called risk retention. Two words. You are going to accept, but you do not have proper strategy to reduce it. So that is called risk retention. So then what third strategy, which is called risk reduction. Risk reduction is also called risk mitigation. What it is? Here, guys, you are going to accept the risk. For example, you are going to invest in the stock, but you have strategy, internal strategy to reduce it. For example, you have 100,000 saving, and I asked you to invest in the stock, and how you are ready to invest, because I told you there could be a gain, also there could be a loss. So you are ready to invest. It means you are going to accept the risk. Plus you have strategy to reduce the risk. What strategy? You're thinking, oh, you have $100,000, so you are not going to invest whole $100,000 in the stock of one company. You are going to invest in diversified way. So this 100,000 you are going to split and you are going to invest into different companies. So this is called risk reduction. Okay, so you are going to accept and you have a strategy to reduce it, but this is the internal strategy. Another example, for example, you have a risk of system penetration, which can be reduced by maintaining a robust information security function within the organization. Like you are accepting the risk by investing in the technology, but you have some strategies to reduce it. Maybe you have installed firewall system to reduce the impact of virus, etc. Then we have a fourth strategy, which is called risk sharing. Okay, risk sharing, it's simply like a insurance, but it's not a self-insurance. It's like a third-party insurance. Third party, don't think like from car point of view, guys. For example, I'm going to give you a loan. I'm a bank, assume. I'm going to give you a loan. I have a risk of default, that maybe my customer will not repay me this money. So what I can do, I can get the insurance from the insurance company. In case if customer will default, I can get the money back from the insurance company. So this is called risk sharing. Risk sharing means that you are going to accept the risk. You are going to accept, but you are going to transfer this risk on the shoulder of other party. That is called risk sharing. Understood? And last strategy, we have risk exploitation. What is risk exploitation? Actually, it is not a strategy, guys, proper strategy, but it mostly the strategy is used by the gamblers. For example, especially when they invest in the stocks, gamblers, you know, those people who will invest for the short time period, right? They don't want to invest for the longer period. No. So they want to make money in the short period. So most probably they are choosing high risky investment, because high risky investments, they fluctuate in value. And when they fluctuate in value, so they have opportunity to get the gain. Okay, this is called risk exploitation. So how you will define risk exploitation? So risk exploitation seeks risks to obtain a high return on investment, like they feel high risk, high return. So we have a last note. There's a one more definition which can be tested in the exam. They will ask you what is the residual risk. Residual word is for the remaining risk. So residual risk is the risk that remains after risk responses are executed. What it means, like once you have implemented the risk strategy, risk response, maybe still you might have a remaining risk. That is called residual risk. Understood, guys? For example, in UAE, if you will get third-party insurance for the car, right or wrong? So there is still residual risk, because if you will hit someone, your car will not be covered by insurance company, the repair of your car, right? So it means there is a residual risk. But if you have full insurance, so your car plus the person to whom you have hit it, so his car will also be covered by insurance company. So residual risk is what? The remaining risk that remains after risk responses are executed. Now, guys, we are going to discuss the fifth stage, which is called risk monitoring. Obviously, guys, risk monitoring means we are going to track identified risk. Okay, we are going to evaluate current risk response plans, like the whatever risk responses you have applied, that risk responses are implemented properly, or there is still residual risks are there. You are also going to monitor residual risk, which I told you, like maybe still risk is left after the risk response, and you also need to identify the new risk in the monitoring. But the point is how we can do the monitoring in the best way, guys. So there are two major sources which as a company we can use to monitor the risk. And the risk monitoring is important for the tracking of identified risk, for the evaluation of current risk response, and for the monitoring of residual risk, and for the identification of the new risk. Which two sources are available to monitor the risk? Number one, those we can use those people, those are closest to the activities. For example, let me give you example. Let's assume you are facing risk of exchange rate. Obviously, exchange rate risk should be managed by finance manager or CFO, right or wrong? So the first way to monitor like how this risk is managed or how this risk response is implemented, the first way you can ask from those people who are closely connected with the activity. Like you can ask from the CFO about the exchange rate risk. But if risk is relevant to the non-compliance, you can ask from the compliance manager, right? So first you can use those peoples are the managers of the department or managers of the operating unit. Okay, so which are in the best position to monitor the effect of chosen risk response strategy. So you can use those people, you can take feedback from them. So second people which you can use to monitor that could be the audit function. For example, let me give example. Audit means here doesn't mean external audit. Audit means internal audit I'm talking about. Like obviously, for example, so you may hire internal auditors. Internal auditors, they may do the audit of the risk of risk management process as a whole also, right? So and you can take a report from them. So they will tell you like where are the weaknesses in the risk management process. Is there weakness in the identification of risk or in the risk response? What is residual risk? So auditors can also help us in the monitoring, because obviously once you will do the audit, they will prepare a report, they will report it back to us, right? So we will come to know what are the positive things, what are the negative things. So audit function can also be used for the monitoring. So these are the 5 stages in the risk management process. Can you repeat what was the first stage? Stage number 1 was identification of context. Stage number 2 was identification of risk. Stage number 3 is risk assessment and prioritization. Stage number 4 is risk response strategies. I told you 5 strategies. And stage number 5 is risk monitoring. So now, guys, we are going to talk about, there is a small model which is called AICPA Audit Risk Model. Okay. So AICPA means American Institute of Certified Public Accountants. This similar model you can also find in ACCA studies, in CA studies. So they are giving their own name, like ACC Audit Risk Model, CA Audit Risk Model, or AICP Audit Risk Model. But the point is that this I'm not going to explain from audit point of view, because we are talking about internal controls. Okay, so I'll explain from the internal control point of view. So here we go, guys. First, let me give you small idea from audit point of view. Let me tell you what is audit risk. Audit risk means to say audit risk is defined as the risk that auditors may express an inappropriate opinion on materially misstated financial statement. So what it means? What does mean by inappropriate opinion? For example, there are certain misstatements in the financial statements. There are certain values which are not correct, but auditors is expressing inappropriate opinion. Like auditor is saying that financial statements are presented fairly. Understood? This is called audit risk. Audit risk, simple. It means that auditors may express wrong opinion. So that is called audit risk. For example, if financial statements are misstated, auditors may say these are not misstated. If financial statements are not misstated, auditors can say financial statements are materially misstated. So this is what is called inappropriate opinion. But from internal point of view, Audit risk will always have, audit risk is the, you can say the myth of, or is the conclusion of the three risks. One is called inherent risk, because our topic is from control point of view. So that is why the question they will ask you from control point of view. So number one, guys, what is the inherent risk? Okay, inherent risk, this definition I'm going to explain now. Inherent risk mean to say, if you will look at the wording is really tricky, but let me first say in simple words, then I'll read what they're trying to say. Inherent risk means say what risk company is facing in absence of internal controls. Like for example, what risk you are facing if there are no internal controls are there. For example, you don't have a proper lock box system for the petty cash. So obviously it means lock box or lock system is the internal control. If you do not have lock system, so obviously there is a risk. Risk is what? Theft of cash. So this is inherent risk. Inherent risk is what risk you are facing, assuming if there are no related internal controls are there. Okay. So then we have a control risk. Control risk is what? Controls are there, but control risk is the risk that controls put in place, whatever controls you have in place will fail to prevent. This is the keyword. You have control here, but the controls are going to fail to prevent an obstacles. Obstacles means say the risk. Okay, the risk. What is control risk? How you will define? Controls are there, but controls are failed to prevent the risk. For example, you have antivirus software in computer system, but that antivirus software is failed to prevent the attack of virus. This is called control risk. Here we have control. Then we have a detection risk. As per the word you can see, detection risk is the risk that an obstacles to an objective will not be detected before a loss has occurred. So let me say in a simple word, detection risk is what? The controls are there, but these risks are failed to detect the risk. Detection is something different and prevention is something different. Under control risk, so controls are there, but they are failed to prevent the risk. Detection risk is what? For example, you have a burglar alarm system, or you have a smoke detection system. So it is installed in the building, but if there is any fire, so they are not detecting it. It means controls are there, but they are not functioning properly. They are not detecting. So this is what detection risk. So when we say total audit risk, so total audit risk may thus be stated as follow. So total risk is always include inherent risk times control risk times detection risk, because total risk you may face due to inherent, due to control, due to detection. Right or wrong? So this is what is the model. I hope so it is clear. Now, guys, I'm going to explain the definition of internal control. What is the definition of internal controls? So here we have a small definition. It is better I'll explain. There's a one famous framework, a COSO framework, which is American framework. It is called Committee of Sponsoring Organization. Actually, there was a committee which was sponsored by different organizations to do the research on internal control. So they have developed framework for internal controls, for the design and for the implementation of internal controls. It is like, for accounting, we have a IFRS or US GAAP as a framework. So same way for internal controls, we have a framework which is called COSO framework. There are many frameworks. One is called COCO framework, ESAC framework. Different frameworks are there, but in our exam here, we are going to talk about COSO framework. Okay. COSO framework, I'll explain at that, but here we have a definition. Okay, so what is the internal control? So let me just give you examples. First, I'm going to explain internal controls in simple words. Internal controls means say what? So these are the actions taken by management to mitigate the risk. What I said, these are the actions taken by management to mitigate the risk. For example, if you will look in your normal life, in your normal office, we are installing cameras for surveillance purpose. So these are the actions to mitigate the risk. Obviously, if there is a camera, so it will reduce the chances of risk. Control doesn't mean it will eliminate the risk, but it should reduce to the acceptable level. So we are using two signatory on the check. This is also internal controls. We are using computer generated invoices. This is also internal controls. We are hiring security guards. This is also internal controls. We are installing biometric system. This is also internal controls, right? So there are so many internal controls are there in our normal life. So, but how the internal controls are defined by COSO framework. So let me just tell you, first question they will ask you, who is responsible for internal controls? He will give you different option. He will say board of directors, management, okay, departmental managers, everyone. So you will select everyone, because internal control is the responsibility of everyone, not only of the management, but primarily management is responsible for designing and implementation. But everyone, why I'm saying, because people has to follow. So that is why we will select the option everyone. Understood? So let's come back to the definition. First, what I said in simple words, controls are the action taken by management to mitigate the risk. This is simple definition. But how controls are, internal controls are defined by a COSO framework. So this similar kind of definition you will find in the COSO framework. So here we go. So they are saying it is internal controls are what? It is a process affected by those charged with governance. Like in internal controls, those charged with governance, they will also participate. What does mean by those charged with governance? Board of directors. This process is also affected by management, like for example, CEO, departmental managers. Like if you are a accounts department manager, obviously you are responsible to design or to implement internal controls within your department. And this process is also affected by other personnel. Other personnel means maybe normal employees, because they have to follow, okay, policies, procedures. These are also internal controls. So other peoples will also participate. Okay, so this now why, let me say one more time, a process affected by those charged with governance, management, and by other personnel that is designed. What is designed? This internal controls are designed to provide reasonable assurance. Guys, reasonable assurance mean to say the controls cannot give you guarantee that risk will be avoided or risk will be eliminated. It will provide you reasonable assurance. To some extent, it will give you some comfort level that we have some controls in place. Okay, so it will, these controls are designed to provide reasonable assurance. It doesn't provide any absolute assurance. It doesn't provide any guarantee. It provides reasonable assurance about the achievement of entity's objective. Okay, and there are mainly three classes of objectives. So how you will define, again, I'm saying internal control is a process affected by board of directors, management, and other peoples. And this process and these controls are designed to provide a reasonable assurance about the achievement of three classes of objectives. Which three classes of objectives? So first objective is operation, second objective is reporting, and third objective is compliance. Now, what is written under the first objective? Operation. So for operations, guys, for operations, we want our operations, guys, obviously efficient and effective, right? So operational objectives relate to achieving the entity's mission. Obviously, guys, if you are profit making organization, so your mission will be according to that, to make money, etc. If you are a charitable organization, your mission is to maybe serve the people, right or wrong? So our internal controls, they will ensure that operational objectives are achieved. We are making money if you are profitable, if you are profit making organization. Okay, so what operational objectives might be there? It might include improving financial performance. We want to improve our financial performance. We want to improve our productivity. We want to improve the quality of the product. We want to bring more innovation into the product. We want to satisfy the customer. So these objectives could be there, and you need to set the controls to achieve these objectives. Understood? Then operational objective also includes safeguarding of assets. So these two keywords you have to remember. Operational objective relates to achieving the entity's mission. Operational objective also includes safeguarding of assets. Obviously, you have a cash, you may have a cars, maybe equipment, all these assets. We want to ensure that our assets are safe. We want to ensure that our assets are in the safe hand and we are saving our assets from the theft. Okay, so here, for example, This could also be safeguarding of assets. Like as I gave you example, for example, if you have a cash, previously I gave you example, if you have a cash, how controls can be placed. So you can place the cash into proper lockbox system, right? If you are making any payments, payment should not be made without proper approval, right or wrong? So these are safeguarding of assets. So please remember this. Then we have certain objectives regarding reporting, because there are total 3 objectives: operation, reporting, and compliance. ORC. O stand for operations, R stand for reporting, and C stand for compliance. Guys, obviously we have 2 types of reporting, right? It could be internal reporting, external reporting also. It could be financial reporting, non-financial reporting also. Right or wrong? So what are the objectives? We want to ensure that whatever we are reporting, okay, to the stakeholders, because stakeholders, they need our reporting to take the decision. For example, shareholders. If you want to invest in the company, you want financial statements. This is also reporting, financial reporting. Right or wrong? So if you want, for example, there could be another stakeholder like management. They want to see internal controls are effective or not. So they want report on external, they want report on internal controls, right? Or they want audit of internal controls. So this is non-financial reporting. So the point is, whatever our objectives, our objective is to make complete reporting, accurate reporting, timely reporting to the stakeholders. The reason is that stakeholders, they will take the decision based on our reporting. So this is what is the objective. Then we have a compliance. Compliance means to say, obviously we have objective regarding compliance also. Internal controls will make sure that we are complying with the laws and regulations. Compliance could include not only health and safety laws and regulation, it can include employment laws and regulation. It can include taxation laws and regulation. It can include environmental protection laws and regulation. It can include internal policies and procedure. It even accounting standard is also part of laws and regulation, because being accountant, you have to follow, you have to adhere with those standards. Understood? So this is what is the memory aid for the COSO classes of objectives. So we have word ORC, operations, reporting, and compliance. Now, if anyone will ask you, what is the definition of internal controls? So you would say internal controls is the process in which board of directors will participate, management will participate, other people will participate to ensure, or these controls will provide you reasonable assurance that we are achieving 3 classes of objective: operation, reporting, and compliance. Understood? So now, guys, I'm going to explain. First, I'm going to explain the COSO components, because COSO framework I have started, as I told you. So COSO definition, I told you like how COSO is defining internal controls. So then I'll explain COSO components that you also need to memorize. So guys, from the definition, we extract the following things. Okay, from the COSO definition, please remember, internal control intended to achieve 3 classes of objectives. I told you: operation, reporting, and compliance. Internal control is an ongoing process. Obviously, guys, it is ongoing process, because you cannot say this way, I have designed and implemented the control, okay, and I will never review it. Obviously, with the passage of time, new risk will arise. You need to adjust your controls according to that. So that is why it is a concurrent process. It is an ongoing process in which we have to adjust controls according to the new risk. Then you also need to remember this internal control process is affected by people at all organizational level. I told you board will participate, management will participate, and all other employees, they will participate and they will follow, obviously. And I also told you internal controls will provide reasonable assurance, not the absolute assurance, reasonable assurance, okay, about the achievement of organizational objective. Okay, and it is adaptable to the entity structure. So obviously, internal controls should be according to the organizational structure or according to the processes. Understood? It should not be like that your process is different, controls are different, right? For example, you are using IT, but you are applying manual controls. So this should not work, right? So these are the 5 key points, 5 key words from the definition you should extract. Now, guys, here we are talking about components of internal control as per COSO framework. So let me show you on your screen this is just a background of COSO framework. So I'm showing you on screen, so you can just go through. Okay, it will not be tested in your exam, guys. So this is the mnemonic for COSO. COSO stands for Committee of Sponsoring Organization. So this you can go through on your screen. It is just a story background of COSO, how COSO came into force. Now I'm going to talk about components. Components means that there are 5 main pillars of the COSO framework. So if you want to implement as per COSO, if you want to implement and design the internal controls in effective way, or if you want your controls must be effective, so you have to follow these 5 components. Components. So there are 3 classes of objectives. 3 classes of objectives. Those are different. Okay, operation, reporting, and compliance. There are 5 components. 5 components. Okay, 5 components, and each components will have different principles which you need to memorize. Straight away you need to memorize. I will explain. Okay, number 1. So first let me tell you what are the main headings of overall 5 components. One is called control environment. Second is called risk assessment. Okay, here we can highlight the word E. Here I can highlight the alphabet R. Third could be control activities. Okay, control activities. Then we have information and communication, and then we have monitoring. So crime could be the mnemonic. Actually, this is the correct sequence, guys. This is the correct sequence. First one is control environment. Second one is the risk assessment. Third one is control activities. Fourth one is information and communication. Fifth one is the monitoring. But to make a mnemonic, so mnemonic will remember crime. So crime will help you to memorize 5 components. So first C stand for control activities. So see, this is the control activity, which is at 3rd stage. Okay, R stand for risk assessment, which is the 2nd stage here. I stand for information and communication. M stand for monitoring, and E stand for environment. Just to memorize this mnemonic can be memorized crime. But what is the correct sequence? This is the correct sequence which I told you here. First one is control environment, risk assessment, control activities, information and communication, and monitoring. If they will ask you to write in essay question, you will follow this sequence. Don't follow this sequence. Follow this one. Okay. So what does mean by control environment? First component. Please remember, guys, control environment is having 5 principles. Second component will have another 4 principles. Okay, these principles you need to memorize. Please remember, in your exam question, he will ask you which principle will fall under which component. You have to remember. So let me explain now what does mean by control environment. Guys, first of all, control environment means a tone at the top. Obviously, if top management will take seriously, if they will work seriously for the controls, everyone will follow and will work for the controls. So tone at the top means a control environment. Okay, so control environment is the set of standards, processes, and structure that pervasively affect the system of internal control. So that is why I said pervasively affects the system of internal control means say it has a wider effect on the internal controls. So control environment simple is that tone at the top, seriousness of the top management, in other words. And to show the seriousness of the top management, or to show or to set the tone at the top, we need to follow 5 principles. These principles you need to memorize. Just you need to memorize these headings, whatever written in the slide here around your screen. Number 1, organization demonstrates. We are talking about organization demonstrates a commitment to integrity and ethical value. Okay, like in simple words, you have to show the commitment to integrity, to the honesty. Like everyone should be honest, and ethical values. Like you have to define what is ethical, what is unethical. So for that, companies can create code of ethics in which they can provide the list of do's and don'ts to the employees. So this is the first principle. Straight away you have to memorize. The organization need to demonstrate commitment to integrity and ethical value. Okay, so this thing you have to do first to set the tone at the top. Number 2, board demonstrates independence from the management. What it means? So board role should be defined separately, because obviously board of directors, they are not responsible for day-to-day activities. They always have oversight role, but management, they are responsible for day-to-day activities. Right or wrong? So that is why the roles and responsibilities of the board and management should be defined clearly. So that is why it's written the board demonstrates independence from the management. Like board should be independent from the management, because board always exercise oversight role for internal controls, but management is responsible for the design and implementation of internal controls. Then third point, I'll tell you in summarized way also. First, let me explain. Third principle is what? Management establish structures, reporting lines, and appropriate authorities and responsibility. So keyword is structure and reporting line. Obviously, when you say structure, it means organizational structure. Like you have to make organizational structure, who is senior, who is junior, who is the boss, who is the employee, who is the CEO. So, and obviously when you define the organizational structure, automatically authorities and responsibilities will also be defined. So this thing we also need to do. Fourth is what? Organization demonstrate commitment to attract, develop, and retain competent individuals in alignment with the objective. Like organization must have a strategies or must have a policies. Okay, our organization must show commitment to attract, develop, and retain competent people. You should not misuse the people. You should attract them, hire the appropriate people, develop them. Like succession plan, make the succession plan also. Okay, develop their career also, and retain those people also. Because without competent people, you cannot run your business. And fifth is what? Organization hold individuals accountable. Accountability means say everyone is responsible for their action. Right or wrong, if you are taking good decisions, you are doing good, you should be rewarded. If you're doing bad, you should be punished. So these 5 things we need to do to set the tone at the top. Number 1 is what? We have to show the commitment to the integrity and ethical value, keyword, integrity and ethical. Second, board must be independent from management. Third is what? We must have a proper structure and reporting line. Number 4, we must have a commitment to attract, develop, and retain competent people. Number 5, we must hold the individuals accountable. So if you will do these 5 things, guys, so this will shape your control environment. So it is written here in simple words. Control environment means to say reflects the attitude and actions of the board and management regarding the significance of control with the organization. As I told you, if they will take it serious, everyone will take it serious. If they will bypass the control, maybe everyone will bypass the control. Because boss is always at the tone, right? Second component, I'm going to explain, that is called risk assessment. Risk assessment, I told you earlier, guys. Here, obviously, I told you like whenever you assess the risk, okay, so you need to normally in risk assessment we check the probability of the risk and the impact of risk, but here risk assessment mean to say risk assessment process, okay, which encompasses an assessment of risk themselves and need to manage organizational change. So let me say what you have to memorize here. You have to memorize 4 principles. You don't need to memorize what is risk assessment, which I already told you. So, but 4 principles you have to memorize. Okay. Number 1. Principle number 1. The organization specifies objective with sufficient clarity to enable identification and assessment of risk. Obviously, what they are trying to say, guys, they are saying that first you have to set the objectives. If your objectives are set with clarity, then you can identify the risk. Right or wrong? So this is that is why they're saying specifies the objective with the clarity. So this is the keyword. Like set your objective first. And once objectives are set, then identify the risk to the achievement of those objectives. across the entity. So what is that? In risk assessment, first you have to set the objective, then you have to identify the risk, okay, regarding those objectives, but across the entity. Understood? Because if you will identify, then you will come to know which risk you have to manage and how to manage. Third is what? You also need to consider the potential for fraud risk. Fraud risk. Obviously, guys, they are saying when you are identifying the risk, you also need to consider where could be the fraud risk, where the fraud risk can arise. You also need to identify this one. And then you also need to identify and assess changes that could significantly affect the system of internal controls. For example, previously we were working manually. Now we are bringing technology into work. So obviously previously risk could be of different types. Now risk could be of different types. So whenever there are changes are there in the environment, so you have to check due to these changes, what could go wrong or how it will affect the system of internal controls. So these are 4 principles for the risk assessment. Number 1 is what? Specify the objectives, identify the risk, consider the potential for fraud risk, and identify and assess the changes that could significantly affect the system of internal controls. Now, third component we are going to define, guys, which is called control activities. What does mean by control activities? Control activities mean to say which actions we will take, right, to manage the risk. So it might include policies. We can set some policies and we can define some procedures which can help us to ensure that management directives are carried out. Like whatever management is asking, okay, to you, you are following. So that is called control activities. Simply the actions taken by management. And it has 3 principles. Okay, principle number 1 is what? The first principle, because there are 3 principles under control activities. First principle, the organization selects and develop control activities that contributes to the mitigation of risk. Like simple, this is the key wording. You have to select the actions, you have to take those actions, which will mitigate the risk. Okay, which will bring the risk to the acceptable level. Understood? Number 2 is what? You also need to select and develop general control activities over technology. So here they are reminding you, don't forget technology. You also need to select, you also need to design certain controls over technology also. Because technology is supporting you to achieve your objectives. Maybe due to technology, you can manage your data in better way, you can increase your productivity. Then the organization deploys control activities through policies. Obviously, you need to make policies, you need to define the procedure. So policies will define that what is expected, okay, what you are expecting from the people. And what are the procedures always put the policies into actions. For example, you may have, I'm just giving example, to define loan, to define policies and procedure. Policy means like a loan policy. Like for example, we are giving loan to employees, it's our policy. So what is the procedure to get the loan? What requirements you have to fulfill? That is procedure. So what is stage number 1? Select and develop actions which will mitigate the risk. Select and develop the actions regarding technology also, and deploy the internal controls through the policies and procedures. These are 3 principles under control activities. You have to memorize, guys. You don't have any other option to do. You have to simply memorize with understanding. Okay, now guys, we have a 4th component, which is called information and communication. Information and communication. So information, obviously, guys, when you are obviously designing and implementing the control, or where controls are weak, where controls are strong, sometimes we need to pass that information, right or wrong. So information system enables the organization to obtain, generate, and use and communicate information to maintain accountability and review performance. Obviously, guys, you should create a proper system for that. Okay, so for information and communication, we should follow three principles. Number one, organization obtains or generate and use relevant in quality information to support the functioning of internal controls. What it means, you should have a proper information where controls are functioning properly, where controls are not functioning properly. Okay, this is the first principle. You should get that information. Number two, organization internally communicate information, including objectives and responsibility for internal controls. Obviously, guys, you have to communicate internally also. For example, you are communicating to the accounts manager that you are responsible for the design and implementation of the internal controls within your department. So you have to communicate internally, yeah, who is responsible for controls. Then organization communicates with the external parties also regarding matters affecting functioning of internal controls. Guys, if you remember in corporate governance, I told you, management also present a report over internal controls to the external parties also.
Evening, man.
Management will assess controls are.
Your face is going down. How can I, man?
Sorry, can you come again? Now we have a fifth principle, the monitoring. Monitoring, as you know, obviously monitoring is the process that assess the quality of internal controls performance over time to ensure that controls continue to meet the needs of the organization. Obviously, through monitoring, you will come to know, right? So where you should monitor over time also, right? Where controls are functioning, where are not functioning. For monitoring, we have two main principles. Number one, they're saying organization select, develops, and performs ongoing monitoring. This is ongoing monitoring. For example, you are working in accounts department, you are accounts manager. On daily basis, you will monitor what's going right, what's going wrong. So if something is going wrong, you will take corrective action immediately. This is called ongoing monitoring. What is separate evaluation? Maybe you may hire some internal auditors, right? They can do the audit of internal controls in your department, and they can report where controls are weak, where controls are strong. Controls could be weak in the system itself also. So that is why there are two types of monitoring: ongoing monitoring and separate monitoring through separate evaluation. Or you can use both, ongoing also and separate evaluation also. Why we need ongoing monitoring and separate evaluations are both to determine whether components of internal controls are present and functioning. Like controls are there and working. And second principle is what? Organization evaluates and communicates deficiencies in the timely manner. If there are any deficiencies in the internal control, that should be evaluated, and how to correct it, that should also be considered. I hope so it is clear. Now we are going to talk about, guys, roles and responsibilities regarding internal controls. Actually, there are two types of responsible parties. One is called internal parties, and second is called what? External parties. Okay, so just you have to remember the headings and just a little bit information. This topic can be tested only in essay question most probably, or in MCQs they will ask you to identify which is internal party, which is external party. Okay, and how they can help us in improving the internal controls. So first I'm talking about internal responsible parties. Internal responsible parties means within the organization we are talking about. For example, so the first internal responsible party could be board of directors. If you remember, I told you a board of directors, they have always oversight role. Okay, the board of director must be experienced people. They must have a sufficient knowledge. They must have a sufficient knowledge, and they must be willing to ask relevant question about the management decision. For example, if management has taken or has designed any internal controls, so they must be capable to ask why this design is there or why this is not there. Okay, so to do this, they must be knowledgeable people. And under board of directors, these committees can also be there: audit committee, compensation committee, nomination committee, finance committee, risk committee. So these committees I have already explained in the previous lecture. So, but board overall is having oversight role. This is what you have to remember. Keyword. Second, responsible party could be senior management like CEO. Actually, CEO is the one who is responsible, okay, to design, to establish, and establishment to design and maintaining the organizational system of internal controls. But CEO, he will not do this thing alone. Ultimately, he is responsible, but he will, obviously delegate these responsibilities at the lower level. For example, to compliance department, he will delegate this responsibility to compliance manager. With respect to the accounts department, he will delegate this responsibility to accounts manager to design and maintaining internal controls. Then internal auditors, they also have a role to play in internal controls. For example, internal auditors, they might do the audit of different department, including internal controls, and they can report it back to the board of directors, right? Or to the audit committee. So they can oversee, like in simple words, first point I can relate with the internal auditors. First point was board of directors. So board of directors, they exercise oversight role through the use of internal auditors. And obviously when internal auditors do the audit, they will also highlight weakness in internal control, plus they will give the recommendations also. And mostly these 5 points you need to remember. Mostly internal auditors, they evaluate controls over the following. They will check achievement of the organizational strategic objective. The companies are achieving their objectives, how many risks they are facing to these objectives, how those risks are managed. They will also check reliability and integrity of financial and operational information. Whatever information we are reporting, so are those information reliable and honest? They will also check effectiveness and efficiency of operations. They will also check assets are safe. They will also check companies following with the laws and regulations. Obviously, auditors, they must be independent people. They must be unbiased people. Then we have other entity people. Other entity people means everyone. Obviously, everyone in the organization must be aware that he or she has a role to play in internal controls. What role? Obviously, if you are a junior employee, you have to follow internal controls. Or if you will see any weakness, you should report it to the relevant people. Like this is the weakness in the internal controls. Okay, so these are 4 people. I told you board of directors, internal auditors, management, and other people. These are the part of internal responsible parties. Now we have a external responsible parties. External parties, like there are some parties from outside the organization which will help us, or which can help us to improve our internal controls. Number 1 is the external auditors. Obviously, guys, external auditors, when they do the audit of financial statements, because primarily we hire them to do the audit of financial statement. So they will also check relevant internal controls to the financial statement. If there are any weaknesses, they will highlight. Understood? So this is how they can play a role. Then we have our legislators and regulators. Obviously, guys, for example, if health and safety laws and regulations are there, they will also, they may come and they will check the compliance with the laws and regulation. If there are any non-compliance, first they will give you fine. Second, they can also give you recommendations how to improve it. Okay. So another example, for example, if you are a university, so you are working under Ministry of Education. So they are also coming for the audit of the university, maybe once in the 5 years. So they will also tell the weakness in the university. So this is how they can also help us to improve our internal controls. Then we have our parties interacting with the entity. For example, our supplier or our customers. They can also help us to improve our, internal controls. For example, you are a manager of procurement department. Okay. So you are going to buy something from a supplier. You told the supplier that you will pass his quotation if he will give you some kickbacks, some commission. But supplier is informing this information about kickbacks to your senior management. So obviously senior management will take the action against the procurement manager. So this is how they can also help us to improve our internal controls. Then we have a financial analyst. Obviously, when they analyze our financial information, they will also tell the weak points. Bonds rating agencies, obviously, when they rate our bonds, so why our bonds are having higher rating or low rating, they will tell you causes for that also. Or other news media, obviously, if there is any fraud, media will also highlight this issue. So this can help the companies to overcome those kind of problems. Then we have a fifth party, which is called outsourced service provider. Obviously, sometimes, we hire people from outside on contract basis to do a certain job. So when they do a job within our company, obviously, they may also find some certain internal weaknesses, control weaknesses, and they can help us. Understood? Like you are outsourcing sometime IT people, sometime internal audit people, sometime maybe accounting people. Understood? So they can also help us to improve our internal controls.